Thank you, Graham, and thank you, everyone, for having me. Before we get started, does anyone remember what the wealth discovery questions are when you should be talking to your clients? What questions you should be asking? Tell me more about your investment portfolio. Does your investment portfolio have guarantees? My name is Santo Filice. I'm the Senior Sales Consultant for Wealth and Retirement Solutions at RBC Life Insurance Company. Today, we're going to discuss about the opportunity that exists with segregated funds, the offering of the unique benefits it offers, and unique estate planning benefits that it offers also there. A lot of your clients today have accumulated wealth, and they may want to think about, how am I going to distribute this wealth with ease? They also want to make sure they've got certain things in place, guarantees, as they've put into their investment portfolios. Many clients may not even know what segregated funds are. So this is a great time to introduce what seg funds are to your clients and the benefits of having segregated funds. So what are we going to talk about today? So a couple of things. Your clients will be asking you, what funds do we choose? Also look at, are you a relationship manager or your portfolio manager? Is there a better way to doing this? What's under the hood of that investment fund? Volatility in the market. Are we comfortable with it? How do we get started? Do you have the tools there to do it? When you're working with your clients and then you've identified their risk tolerance, how they feel about market volatility, how they feel about putting money away, there's some common questions you may get asked from them. Once you've identified their objectives, concerns, and risk tolerance, what are the best funds out there? Which have the best returns? Which funds would you recommend? How do I decide which fund to choose that fits right for me or my client? How do I keep up with the market updates or market research that? Do you have a team behind you that does all that? Are we chasing returns? Are we trying to time the market, or does time in the market matter? Everybody knows about emotional investing. When markets are strong, markets are good, we all get excited, we're happy. We're really happy about things. As there's a couple of valleys that happen, maybe the markets start to change, and then market opportunity starts dropping. We start to panic then at that time. And then what happens? You may get a call from your client. What's going on in the markets? Maybe we should sell, move off to different investments, maybe go to more guarantees. And then what happens after that? The markets start to go back up. What I'm saying here is you want to make sure you have a roadmap with your client. Once you've identified their objectives, their concerns, their risk tolerance, and have a disciplined investment approach in place. So getting the clients to feel good about, hey, when markets are good, they're great. If markets drop a little bit, can we handle that? How does volatility work? Have that conversation. Stay on course. That's why we have the roadmap in place. Do you have the process as an advisor? What do I mean here is, how do you want to be identified as an advisor? Insurance advisor, investment advisor, or financial advisor? Do you have the tools to help your client? For example, here, what do I mean by tools? Having the technology. Are you able to do the market research yourself? Do you have access to market information, updates, and all that? Do you have the resources there too to do that? Do you have the time? You're busy. You're meeting with clients. You're meeting with new prospects as you go forward. So are you able to put all this information together? The other thing is, do you have the time to build an investment portfolio for your client based on their risk tolerance, on what they've told you, what their concerns and everything else are? You may not. You may lean on to people like myself and my team that we can provide you with information that is needed to help you build out an investment portfolio as you go forward. That's why we're here to help you. Building an investment portfolio is like building a food dish. You got to have the right ingredients, put it together. You have to have the right combination of fixed income and equities. So if it's Canadian fixed income, US fixed income, international fixed income, or same thing on the equity side, Canada, US, international equities as being part of it. Does it fit your client's needs? just like putting a food dish together. I have the right ingredients, make sure I have great flavors, great returns, good returns over a period of time to help my client achieve their long-term successes as they go forward. So understanding risk tolerance, this is where does the client fit? A couple of questions you need to ask your clients. Are you willing to take on more risk today? Do you want to take on more risk? What is the purpose of having this investment portfolio? What do you want it to do? Are you using it for retirement? Are you using it to leave money to the next generation? Are we comfortable with risk? The longer we're in the market, more gains. The more risk we take on, the more gains. But keep in mind, we may have a couple of valleys there along the way. What you're seeing here is your typical balanced portfolio here that is in place. We've seen what's happened to the economy in the last year and a bit with inflation. Before we used to look at a balanced portfolio, a 60-40 split, 60% equities, 40% fixed income, maybe some cash there, whatever. That may have changed now. Look at the cost of goods and services. We may have to tweak that. Do I take on more risk? Am I comfortable with taking more risk? I always say this, the longer we're invested, the more comfortable we become with volatility. So maybe when you're meeting with your clients and your prospects and you're reviewing their asset allocation profile, updating their KYC, are we on target to where we want to be? Maybe we should be taking a look at adding additional risk to our portfolio and try to get more gains. Keep in mind, the key to having a strong investment portfolio is diversification. That is key. Having the right mix of fixed income, the right mix of equities, is it Canadian equities, US, international, global equities. Same thing on the fixed income side. And this slide here shows you, if we look at 2013 to 2022, the different asset mix for balanced portfolios. In 2013, take a look at, what a balanced portfolio looked there. US equities was the bulk of it, with international equities. Portion of it was with some Canadian equities and cash and bonds and all that. If you go to 2022, you looked at what the economy was looking like at that time. We had more sitting in some negative markets there, but balanced portfolio was a combination of equities, Canadian equities, international, US bonds, fixed income, and all that. So we're trying to build out a balanced portfolio. 60-40, is that going to work for the client? It may. Still today, it may not. That's pretty standardized. But the question is, when you're sitting down with them, identifying their opportunities, their concerns, what's the objective, then you're able to build out the investment portfolio itself. Now, the other key thing, you as an advisor, he or she, do you have time to always monitor everything? Do you have time to rebalance your client's investment portfolio? Things change in people's lives. The economy changes too. So are we more comfortable having more risk, more equities for growth potential, or do we need to start to lower that and move towards more fixed income, depending what's happening there? Do you have the time to do the research? Look at the market trends, what's going on there itself? Do you have the team that can help you provide that as you go forward? Having multiple layers of diversification is the key. It's the key between growth and stability. When we have a good fix of diversification, where we have one area maybe doing quite well versus another area of the investment portfolio not doing that well. The one that's doing quite well helps subsidize the one that's not doing that well. Maybe we have to make a little bit of tweak there, but having a right diversification, multiple layers, it also gives you a smoother investment experience as the markets are changing with your clients. This shows you here different, diversification layers between cash, fixed income, Canadian equities, US equities, international, emerging markets, having a diversified portfolio over a 25-year period of time. But one of the greatest tools that you can use here and share this with your clients is the index chart. Every year, Morningstar publishes the index chart. This is a powerful tool that can be used here. This shows you how markets have performed through the times over a period of time. Yes, we've had some valleys, we've had some peaks, we've had more peaks than valleys, but it shows you that long term, the markets will perform better long term. As I said before, let's not try to time the market, time in the market that really matters. So if we're putting, one of the best strategies is using dollar cost averaging, putting money away, either for retirement or for a TFSA or for a non-registered for a rainy day. The longer we're in the market, the more comfortable we become with volatility. But this is one of the greatest tools that you can use today using the index chart. We do offer this as a digital copy. I will send it to Graham Allen later on today, and Graham can share it with the audience as we go forward. As I mentioned earlier in the presentation, are you a relationship manager or a portfolio manager? How do you want to be seen with your clients? Insurance advisor, investment advisor, or financial advisor? You want to be the quarterback. You want to have a team behind you that can provide a number of things for you, the tools, the updates, the market updates, all that other great stuff that comes with it. And having a strong company behind you there, money management, means a lot. For example, look at RBC Global Asset Management. They manage the RBC Segregated Funds platform. You've got a top money management team. They will provide you the market research, the global outlook, investment outlook, the daily market updates if you wish to have that. They'll tell you about what's going on in the markets currently, today and tomorrow, and where do they want to go. Looking at us right now, we have a number of individuals, over 300 portfolio managers globally there itself. You have 18 investment teams that are doing the research for you. They're providing all the tools that you don't have time to do yourself and do all the market research and share that with your clients. Where we ourselves, our team, have access to the information from RBC Global Asset Management, and we're able to share that with you as you go forward, which we do either on a daily basis, if you want a daily market update, or quarterly or annually. It's there for you. Looking at who we are, we're globally across the world today. Bulk of it in Canada, the US, international, we're right around the world. We've been managing money for many, many years. You want a strong team behind you. You want the team choose a strategic asset allocation. RBC Global Asset Management does develop long-term views on a global economy, builds the roadmap, for in the markets, and also navigates through changing markets, the ups and downs. We have an election coming up. We don't know how things are going to go. Things are progressing quite well right now in the markets. The markets are up today itself. Tactical asset allocation. This is where your money manager, he or she, the team, manages the asset mix. Are they well positioned in the market, especially with market conditions are changing? Can they tweak on the fly if they have to? Having a strong selection of good funds to be part of your investment, your client's investment portfolio, the RBC funds, the PHNN, Philip Hager's and North funds, the Blue Bay asset allocation funds too, that are managed out of the UK, out of our UK division for RBC Global Asset Management, getting that global exposure. Having a professional team that is experienced, that works for your clients, to make sure that the right investments are in the portfolios, and they also stay aligned with your clients' investment objectives and what they want to achieve in their lives. As looking at the process that we do, we look at it from a top-down process. Make sure we got the right asset mix. We assess the economy out there. We look at other different opportunities that are out there for us. Develop the guidelines. We manage, if you want portfolio funds, we've managed over $145 billion of portfolio funds. We manage close to $600 billion of asset allocation there today of funds. Having a strong investment team behind you, that's what you want. Let them do the work for you. Let them choose the investment options that are in the funds itself. Let them build that fund for you itself. Let them monitor it, let them do everything there. That's what they're being paid for, to do that. Where you, as the advisor, he or she are able to share the information with your clients, provide the market updates, build up the investment portfolio, using my team and myself, or choosing a fund that you wish with us. Now, many of you have heard of Rip Van Winkle. There's a Rip Van Winkle investing. It's based on a short story written by Washington Irving back in 1819. Rip Van Winkle wandered into the mountains years ago after he had a bit of a tiff with his wife. Along the way, he met a couple of individuals. He had some liquor, and then he fell asleep. And he fell asleep for 20 years. He woke up after 20 years. He found himself that his beard had grown very long, foot long. His wife had died. His children all grew up, and he missed the American Revolution. When we look at the Rip Van Winkle investing, we also look at Warren Buffett. And one of Warren Buffett's greatest saying is, if you can't own a stock or an investment for 10 years, you shouldn't own it for 10 minutes. Are you looking for superstars? Are you chasing returns? That may work well today for a minute or two, may not work well tomorrow. Are you always trying to time the market? What really matters is time in the market. You want to make sure you're holding quality investments for your clients, quality companies for a long period of time to meet their investment objectives. And so they hit, their objective in retirement or what they want to do with the money. The approach for Rip Van Winkle aligns with clients, own well-managed portfolios or investment portfolios, being proactive. We can look at an RBC Select Balanced Portfolio Fund if you wish. This is one fund that does everything for you. Or we can look at individual equity funds, individual fixed income funds. Keep in mind, the longer we're invested, the more comfortable we become with volatility, and we have a good, smoother effect there for good returns long term. So, just to recap very quickly, time in the market will always beat timing the market. Let's take away the emotional investing. Okay, we have a roadmap. Let's put that roadmap to good use there. That's why you build the investment plan. If the client needs to tweak the investment plan from time to time due to something that's changed in their lives, you'll make those changes. Let's hold good quality investments, part of that. Make sure they're long-term to meet the client's investment objectives. Invest for long-term. If we check the markets on a daily basis, our investments, we can drive ourselves crazy. But if we put the roadmap in place, the plan, and the client gets comfortable with that, then they probably won't be checking that on a daily basis. Let's also let's continue to look for markets, be in the market that's long-term. So we don't have to stress over anything there. Remember, volatility. Volatility is good. It's not bad. The longer we're invested, the more comfortable we become with volatility. And that volatility starts to go away there from us. We're more comfortable with it. So let's take a look at the RBC segregated funds. Why consider us there? We have a strong money management team. You identify the client's risk profile. We're able to build the investment portfolio, either non-registered, registered, or TFSAs. We take the complexity investment away from that. We have a diversified approach there, choosing the right investments, make sure we got the people monitoring them properly, and we have the right money management team behind us to get through that itself. This is a slide. We've been here before, guys. We've seen recessions. We've seen markets ups and downs over time. This just shows one of our funds, our Select Balanced Portfolio Fund, over a period of time, how well it's done. And you look at it, 2020, we've done quite well here in the marketplace. So we've gone through different crises along the way. What I'm saying here, and if you use the index chart, markets always outperform over time. The worst time, investors will try to redeem when it's the worst time. We saw what happened in 2009 with the subprime mortgage market. We saw a big drop in the market. Then what happened after that? We saw markets continue to grow. We saw what happened in March of 2020 when we saw COVID. We all went to shutdown. Yeah, the market did drop. What happened after that? Market continued to grow, and the market's been continuing growing quite significantly. So keep in mind, if you got out of the market at that time, you may have missed a huge opportunity, huge growth opportunity long term. A lot of your clients right now have made a lot of money in the markets in the last number of years. Now they're trying to decide, what do I do with that money? How do I preserve it? How do I distribute it with ease at the end? So you've got opportunities to speak with them. There's 11 basic truths of investing. I'm not going to go through all of them here. I'll just pick out a couple of them. Diversification is still the most important investment strategy. It's time in the market that matters, not timing the market. Somebody else will always tell you, my investment portfolio is doing great. It's been doing this and this and that. That may be great, or that's what they're saying. It may happen or it may not be happening. Keep in mind, markets will go up and down, okay? But over time, they tend to go up as long as we stay invested long term. Always continue to look back at the index chart. That will show that you can use with your clients. As I said, I'm not going to go through everything here, but keep in mind, number 7, volatility decreases the longer we're invested. I love that line, and that's the truth. Focus on where the markets are going, not where they have been. Look at your roadmap, look at your financial plan, and stick to that financial plan. Why segregated funds? I think everybody knows there's 5 key points to seg funds. You have a principal guarantee, a maturity guarantee, potential creditor protection, being able to bypass probate, name beneficiaries, bypass and keep it all privacy. Nobody needs to know who's getting what. You're able to lock in your gains by having resets in your portfolio, in your investments, if you wish. Here's a slide that shows you a difference between a GIC, mutual funds, and seg funds. You know, great thing with the seg funds, the estate planning benefits, being able to bypass probate. Keep in mind, what is the cost of probate? You know, seg funds offers named beneficiaries. Some mutual funds and non-redeemable bank GICs, the registered funds, will be able to bypass probate, but not the non-registered stuff in mutual funds or GICs. But keep in mind, what is the cost of probate? Between probate fees, executor fees, lawyer fees, accounting fees, could be somewhere between 8% to 11% of the total estate value, and the time that it takes to settle an estate. It could be very quickly, it could be up to 2 years or longer. On a segregated fund, it could be within 7 days. When the person's passed away, we can settle the death claim and pay out to the beneficiaries. Why RBC Insurance? Why are the RBC segs? Simplicity, strength, and trust. Simple product offering. I'm going to share that with you in a moment. The strength is who we are. We have the RBC Global Asset Management Funds, PHNN, Blue Bay. We are a trusted brand also there and out there. So use that to your advantage with your clients. We offer 3 segregated fund contracts. We take deposits to age 90, no investment restrictions whatsoever. The Invest Series, which is a 75% maturity guarantee at age 100, with a 75% death benefit guarantee, 38 investment options to choose there. Very low MER. Series 1, we offer a 75% maturity guarantee, 10 years, 100% death benefit guarantee as long as you do the deposit before age 80. But keep in mind, we take deposits to age 90 here. So any new deposit between the ages 80 to 90 under Series 1 will have an 80% death benefit guarantee. But anything before age 80 will always be 100%. You've got 27 investment individual funds plus 8 portfolio funds. We have Series 2. Works exactly the same as Series 1, but the difference is Series 2, we offer portfolio funds and 12 investment funds. And you have annual resets to age 90 on the Series 2. If you want more information on this, reach out to Graham or reach out to myself. We'll be in touch. So what's our competitive advantage? Simple contract, 10-year maturity guarantees. We have a competitive CBO, which I'm going to share with you in a moment. Death benefit guarantees, deposits to age 90, no investment restrictions whatsoever. Client-initiated resets, strong money management team, brand recognition, lower MERs. We reduced them back in 2017, and that's from $1. Annuity settlement options we offer, and plus 100% equities if your clients want to go into. So if you got the 85-year-old that wants all equities, they can go into equities, 100%. We offer also a chargeback to advisor option here for you. We no longer offer DSCs or low sales charge. We offer CBO. So if you're in fixed income, balance funds, or portfolio funds or equities, we pay 3.25% gross commission. And it's a pro rata chargeback over a 24-month period. At the end of the 24th month, chargeback's gone completely. So if your client leaves you in the first 12 months, you don't owe us 100% of the commission under the CBO. You owe us only 50% of the commission back then. As I mentioned, at the end of the 24th month, chargeback period is gone, and your trailer fee will kick in month 25 at 1%. We also offer front-end load if you wish to, and we offer F-class also. Now, we do offer annuities too. We've made a huge comeback in annuities because the way the interest rates were have been up. Now we're seeing them come down, but still, annuities are still are very good for a client's retirement portfolio. Our sweet spot is between the ages of 50, the age of 68 to age 80, up to $250,000. Our compensation on the first 100,000 is 3%. Next 100,000 is 2%. The remaining balance is 1.5%. So we've made a huge comeback on annuities in the marketplace. Here's my contact information. You can take a picture of it. It's my email address, and my telephone number is there too, if you wish to get a hold of me, or reach out to Graham, and he will put you in touch with me. Thank you very much for your time. I appreciate it.
Santo, thanks very much as usual. Some highlights in there, hot spots for me anyway. We'll leave the product stuff for you to deal with individuals. But the emotional investing slide, let's talk about a volatility toolkit. You basically touched on it there. The emotional investing slide, the index chart, it's something to go into in a lot more detail. I didn't do it justice here because you don't have time. We've been here before. It's the same story. Let's just embrace it and work with it. And 11 truth slides. Those 4 pieces are fantastic. I've had a couple of requests behind the scenes here personally for the index chart. We'll make sure we get those out. Couple of questions quickly. Do you have any good references to see where the markets are going other than your crystal ball?
We do. RBC Global Asset Management provides us a daily market update and also a quarterly update and global update to see where the markets are. We continue, to be very strong in the market right now. The U.S. market's performing quite well. Canada is still undervalued. Still, there's an opportunity to buy securities or funds here. They're cheap still. Even with the way, even that the election's coming up in the US right now, they don't feel it's going to be a huge impact whoever's in the market, whoever gets in. So they're not feeling that. But we do have the tools. We do have information that I can share with you, Graham, and we can cascade it down to everybody.
Obviously, individually as well, yourself and the rest of the wholesaling team nationally. And lastly, before we shut things down, are tax fees deductible for F-class funds in a non-registered account?
On a segregated fund, no, they are not. Now, I get a little bit of pushback here from time to time. I always say, have the clients speak to their tax accountant who prepares their taxes. But it's I know on the mutual fund side, F-class is you're able to deduct the fees. We do offer an F-class on our seg funds, but as of right now, you cannot deduct the fees. It's a gray area, very gray area. So the best thing is have the client speak to their tax account there.
Wonderful. Well, on behalf of IDC, thank you for another stellar performance. And I'm going to hand this back to Don now and for the next session. Thanks, Santo.
Thank you. Take care.